Again, we've got a little bit of a wind up suggesting that we're going to go again. So it's getting a little bit busy there, so I don't want to overcrowd the chart. But that's all pointing to the potential of 38.28, but potential overperformance to that, because that's what happened last time. We got one setup. It wasn't quite the right moment. It started its move, but went into a holding pattern and squeezed again. And then it was released and then it overperformed. And it seems like that as well. So it's hurry up, start, relax, wind up some more, and then go. And so we're very bullish on silver right now. And I think in percentage terms, that's going to be an outperformance to gold.
FrancisHunt, widely known as the market sniper, sees a familiar technical setup forming in silver that could lead to another breakout. He draws parallels between the current pattern and two past instances when silver consolidated, paused briefly, and then surged sharply, eventually even overshooting its projected targets. Spot silver recently surged as much as 4% to reach $38.47 per ounce, marking its highest level since September 2011. Meanwhile, U.S. silver futures for September delivery climbed even higher, touching $39.12. This kind of divergence between spot and futures prices is rare, as arbitrage mechanisms typically eliminate such gaps quickly. Earlier this year, a similar price dislocation occurred when speculation around new U.S. tariffs on silver imports drove futures prices higher. That temporary arbitrage opportunity also increased leasing demand as traders scrambled to source physical metal for shipment to COMEX-linked warehouses. However, that momentum faded quickly after the White House clarified that silver bullion would not be exempt from the proposed levies. According to Hunt, silver's price is now aiming for a technical target near $38.28, with a high chance of overshooting that level, just as it did in previous rallies. The metal has already risen by 33% this year, outperforming gold in recent months. This strength reflects silver's dual role as both a monetary asset and an industrial metal, particularly with its growing importance in clean energy, such as solar panel production. Hunt notes that silver has the potential to outperform gold in percentage terms. For instance, if gold moves from $3,300 to $3,700, a gain of about 12 to 15%, silver might deliver even larger returns. Still, he cautions that silver's momentum is tightly tied to gold's performance. If gold stalls or weakens, silver and other metals like platinum are likely to remain range-bound. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Let's go have a look at that silver on its own, and I'll come back around at the same time frame and answer more specifically on the gold-silver ratio. I want to highlight a couple of things that happened previously as well, because I think we're getting a little bit of a doubling up event as well. Let's go to the 4-hourly time frame, a little bit lower. I'm even more bullish the silver now. So some people will say, but hold on, weren't you the guy that also said the gold-silver ratio could spike higher? Yes, we'll come back to that, and I am that guy, and we'll explain that. But right now, that's not the highest expectation. We had two wind-ups here. One was a fractal of the other. We got part break, and then we overperformed for the target. The target, this was quite low. In fact, these lows were in and around 31s, by the way, so we're doing well. We're working our way up. Some people are, there's not enough gratification. Setups all the way, overperformance to targets, and then there was a degree of exhaustion. What happened is you got a big setup, and then you got a secondary setup. And then once it started to move, you got a fractal, a third, smaller one, that continued to drive us higher. So there's a little bit of similarity here, and I'm going to show you why I say that. So we drop down to the current price behavior a little bit more closely, and I'm going to throw my indicators on to make these things pop a tiny bit more for the untrained eye. So that in itself is a winding up setup. That is suggesting $38.28. Remember last time we got an overperformance on the big one with the second helper that came along. We've got a similar situation with a little bit of a helper over here as well. Again, it might not pop for the untrained eye, so I'm just going to highlight it, but you're in there. So you sometimes have initially a slow start and you wind up again. Now, we maybe just didn't get the right data about unemployment or something else and wanted to go, but it was a bit of a hard hard sell into the wrong kind of news. So it coils a second time on a smaller time frame. So we've got that happening, and I'm going to put again the indicator on that, and I'm going to stick it on there. And you will see that again, we've got a little bit of a wind up suggesting that we're going to go again. So it's getting a little bit busy there, so I don't want to overcrowd the chart, but that's all pointing to the potential of 38.28, but potential overperformance to that, because that's what happened last time. We got one setup. It wasn't quite the right moment. It started its move, but went into a holding pattern and squeezed again, and then it was released, and then it overperformed. And it seems like that as well. So it's hurry up, start, relax, wind up some more, and then go. And I'll just point this out as an interesting repetition, like a sort of a mini cycle repetition. And so we're very bullish on silver right now. And I think in percentage terms, that's going to be an outperformance to gold. Gold going from roughly where it is around the 300s right this minute, going to 3,700, let's say. That's about $400 on a 3.3. $300 would be about an 11th, so it's a little bit more. It's about 20%, I would imagine, that we'll beat that on the silver here. And we could also be beating it on the platinum. That's almost the contest, actually, for the outperformer for me, those two at the moment. But you need the king, the old aging king, to get up from his table first and move. So we're very dependent on gold going up. If the gold pattern fails or extends a little longer, all of this will be also put on ice again for a while. So please understand, it's a bit like the altcoins can't go up if Bitcoin doesn't. Only gold is the original and silver is the original follower. So they need both. So in terms of the gold-silver ratio, I would expect it to go down. Let's bring up that chart because your question was originally on that. And then explain why did we say careful. You can't say exclusively that the top is in on the gold and silver ratio. And I want to remind people of those details of why we said that. Right now, we are having a bleed out crisis. It's a weak economy, in my opinion, despite the statistics. I feel that there's a lot of misrepresentation. You've had 315? I'm not quite sure. 215,000 jobs removed from the non-farm payrolls that were claimed to have been done just in the first half of the year. So as well as Happy America Day, happy H2 for everybody else, we're into the second half of the year. So I'd expect this to continue down. But the warning is, if you suddenly get a crisis, you see continue down, there's a bullish phase, continue down. If you suddenly get a major escalation in the crisis, that there's a dash for liquidity where everyone panics and even gold sells off a little bit because nobody's got any money. Let's say global bank hack, pandemic Mark II, a shock and awe event of an economic nature or non-economic nature but has economic repercussions like World War III. Anything of that nature. And I do feel we're being set up for some big problem to come. What tends to happen is everything gets sold because you have to have money. And in that environment, gold doesn't go down as far because the biggest buyers are the permanent money, the long-term money, the central banker money, and they will gobble up and they'll dump treasuries for gold. They're not going to be buying silver. And that's why silver is more volatile to the downside in a demand-destroying event type environment. And I still feel there's an event of that nature. We're bleeding out and we're managing to have a very difficult market, which is releasing some of the pressure, but I fear it will go into a capitulation and a major event at some point. That's when you get that secondary move. That's when you go there and then you still get a blow-off. Then afterwards, you can talk about what comes after that. As you saw here, you had a pullback there and then you still went higher. And if we look at CV19 as an event, if you think the crisis has to at least match that by scale, and given the debt situation, the repo market situation, the likely derivative situation, they only get more intense, not less. We didn't fix anything. We haven't been climbing down the mountain and got less far to fall. We've been adding. Just look at the big, beautiful bill. This is not taking you in the right direction. You're adding, piling on more and more. So if you're in the camp that there is at least the equivalent of CV19 type economic event to occur, only different themed, because nothing is identical, identical or bigger, which is my position, then you should expect that at some point everything that isn't nailed down is going to need to be sold. Even good assets, which I consider gold and silver both to be. In that environment, silver sells more because there's no central banker bid who can be buying gold and are less emotional, less affected by whatever that event may be. So just an additional clarification. While we're generally in a bullish setup for gold and silver and platinum, I expect silver and platinum to outperform gold.
FrancisHunt recalls that when gold was trading near $2,000, he identified a technical structure indicating a potential move to $3,000. That target was eventually reached. After a brief pullback, gold resumed its upward climb, driven by escalating geopolitical tensions and renewed tariff concerns, ultimately reaching the next significant psychological milestone of $3,500. On Friday, gold prices rose for the third consecutive session, reflecting continued strength in safe haven demand. Spot gold edged up 0.4% to $3,334.99 per ounce, while U.S. gold futures gained 0.6%, settling at $3,345.30. The rally followed President Donald Trump's announcement of fresh tariffs on Canadian imports, along with broader threats targeting other trading partners, developments that have reignited investor interest in defensive assets like gold. Amid record stock market highs, gold continues to attract investors seeking shelter from uncertainty. Analysts note that every dip in gold is increasingly viewed as a buying opportunity, reinforcing the metal's status as a store of value in a volatile macroeconomic landscape. Hunt believes the bullish momentum in gold is not over yet. He also suggests that a short-term dip, potentially to the $3,200 range, could materialize before the market gathers enough pressure for the next breakout. The price action, in his view, remains structurally sound, and any correction at this stage would likely be a setup for renewed upside rather than a reversal. Let's get back to the interview.
I suppose for the precious metals fans, I'm really excited about this current move at the moment, and it's sometimes best explained with a chart, so I'll maybe go straight there because I can walk you through it. And I can say to you, we made 3,500. Let me get that share screen up and running. Some folk have been a little bit impatient because, we kind of made 3,500. You may recall, Elijah, we were with you on show and when we were on a 2,000 point, and we pointed out there's an HVF structure just sitting on top of the 2,000. The low was about $2,011, and we said next stop 3,000. That was a big move. It was a breakout. We said once, twice, three times a lady. We showed you that technically, and we made that 3,000. We had a little bit of pullback, but actually we continued. We had the tariff tantrums, and actually we got a second surge that took us to the logical next round number that sits between 3,000 and 4,000, and that was the 3,500. So that is a touch just at the 3,500 level after passing the 3,000, which is somewhere down here. And this has formed a beautiful continuation pattern. Initially, there was some hard selling. You could see strong selling off leg there, a bounce, selling off, bit of volatility and chop going into a 3,120 low. That kind of defined the range, 3,500, 3,120. And what we've been doing is we've been tightening with inside that range. And the overall opinion is continuation is expected. So this is a continuation pattern. It's also a volatility constriction continuation pattern, which is likely to lead to a tightening that gives you built up pressure that powers the next leg up. And we've been performing beautifully towards that. So just to change to a slightly more shocking pink color there, this is a simplistic diagrammatic from the pivotal highs to the pivotal lows. We're kind of here. We look a little bit toppy. I think we could roll over for a semi-dip more. We might even make it here. So I'm not saying this is the absolute final low, but this is a squeeze. And we often say that. We sometimes say squeezy, squeezy, Japanesey, and as kind of catchphrase for us. So we have a defined range, which was that high, and that key level, which sits between 3 and 4K, the obvious round number 3.5. I've drawn the blue line there for that. We sort of had a low level at around the 3,120. And what's actually happening is we've made a lesser high and a higher low. So this is constriction. This is the ironing out of the volatility. And what tends to happen after you've made a kind of really substantial move, don't forget, we were 2,000 November 24, and we said 3,000, and you've done 3.5. Now, done. We did just a technical touch and pull back. But that's a really substantial move, an excellent move. And it's understandable now that you'll have a bit of a rest period. This was April, I think, the high. That was peak tariff tantrum. That is a key moment, by the way. I'll point out to our American audience, hello and happy birthday to you all. Just missed your July the 4th, but wishes to all your American followers. What's happened? That was peak tariff tantrum. And on that day, rates spiked up, the dollar went down, and gold blew off to that 3.5 high. It takes you back to April. And then tariffs were walked back. The tone was changed after quite an inflammatory tone. So that just warns that every time rates go up doesn't always mean the dollar goes up. Just a little bit of a warning, because there's some people with adverse messages. It can mean that, and it could still happen. I'm not saying it won't. So there's a bit of fiat news for you, but in the end, gold wins, and this move is looking for 3,700, 3,750. So between 3.5 and 4,000, the next logical level, and this has derivatives and pegging as part and parcel of this, and you tend to have sort of orders stack in a bid stack around round numbers. That means you tend to get vacuums. If instead of everything being evenly distributed, you tend to get vacuums just before logical round numbers, and then many more orders stacked at the round numbers. And we call that voids and vacuums. And that sees you move very fast. And you make the same profit when you cover a $10 move, whether it's $10 between 3,669 and 3,679 versus 3,690 to 3,700 or 3,740 to 3,750. It's still $10, but you will get different degrees of stacking in depth across it's not evenly distributed, and you tend to get very quick moves in the numbers before round numbers, and it builds momentum, and then it often shoots through, and then it pulls back through the round number. So our expectation is there's a 370 run in this setup. This setup isn't necessarily complete, and I think it can come a little bit down, but I don't see it coming all the way down. I think buy limit orders in a box round here for investment gold would certainly be a great entry, and we are actually taking a trade on that, which we expect. We're not day traders. We'd expect the entry to occur midweek next week in and around that pink box level, and then we'd expect to see a 3750 run. Don't forget, you'll be buying below 3295 if we're correct, below the 3300 mark. Look to accumulate. I'd probably place stops initially at the secondary low, so that's why I've pre-positioned this risk-reward profile for those that like a trade. Remember, non-advisory. We take ownership for our own outcomes. This is not advice. It's just talking about what I intend to do, and in part process already am doing. So that's a target. By the way, if that was the final low, that stop would go up to there, and that increases your reward and buys us the right to add further as we break the green line. So if I'm allowed $1,000 risk, and it was $1,000 risk at that deeper stop to there, and I now reduce that, I've bought the right to wait up to maintain myself at that $1,000 risk if that is run. So that allows you to get fairly big, and then that will give you a very spectacular 25.9. Of course, if you're adding and it's trading up, your average entry won't still be down here. It'll go up a little bit, so it won't be the full 25 RRR. But that's how I manufacture a trade. That's what we do in the marketsniper.com in our community with Method. These squeezes are rare opportunities for tight risk and asymmetric reward. Let's say you're not a trader. This is all just too technical for you. It's a great time to buy investment gold right now, in my opinion, and capture the prices here, and through the next few days into midweek might come off a tiny bit. My expectation is you're going to be taking the next big peg levels in those derivatives. It's called pegging because of derived markets on those round numbers, and I think it's north of 37, potentially 3750. So gold, very positive.
Breakouts often begin quietly, just a pattern forming, a price creeping, a divergence missed by many. Yet in silver's case, the technical signals are becoming harder to ignore. With its dual utility as both an industrial backbone and a monetary refuge, the metal is carving out a distinct path of strength. As historical echoes of past surges grow louder, today's chart formations could hint at tomorrow's headlines. But with momentum still tethered to gold's performance, silver's flight may not be entirely self-propelled. Could this alignment of technical pressure and macro catalysts send silver soaring past its decade-old ceiling, or will a stalled gold rally leave it grounded once again? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.